Something called DeepSeek is causing a deep dive in the stock market. The Chinese upstart is making waves with its cheaper style of AI, and that has sent tech stocks downward, especially Nvidia. Joining us now from the Armstrong Advisory Group, Managing Partner and Chief Investment Officer, Chuck Zodda. Chuck, thank you so much for taking the time to talk to us.
Absolutely. Great to chat with you today.
So, Chuck, let's talk to our viewers who saw the push alert pop up. Maybe they saw this run across their screen and they're like, what does this mean? And how do we get into this shakeup? So talk to us about, the tech giants here in the US and in Europe who were like, whoa, wait a minute. This is not good for our bottom line, for us making money. Just explain that in very layman's terms for people who are just not a part of this world. What happened and why is this a shakeup?
Yeah, so here's the basic thing that happened is about a week ago, DeepSeek, who is a Chinese AI company, came out with the most recent version of their AI platform. And the big claims on this are that it was way cheaper for them to develop it than previous versions, but also that it's way cheaper to operate. And it's also an open source model, meaning that anyone can take it and basically use it however they want. They can develop off it in any way that they want to. And so the reason why this has kind of thrown markets for a loop here is because for the last 2 years, the dominant story in artificial intelligence, at least in the United States, has been if you want to build better models that are more realistic and can do more things, you need more and more computer power and more training in order to do so. This has basically said, no, you don't actually need to do that, since this model from DeepSeek is pretty close to on par with some of the best American models. And so the question that is out there is, hey, do we need to keep spending way more money each year on more and more computer chips in order to build more advanced models? Or do we not need to do that? And maybe there's a better way to do this where we can be more efficient and not need to spend as much money. So that's why you're seeing the technology sector, particularly companies that are really tied into artificial intelligence, either with software or today really with hardware, they are feeling an awful lot of pain because there are questions as to what semiconductor demand is going to look like for the next few years after this. And that's a question that wasn't really present until the last week or so.
All right, so Chuck, so now that we have everybody up to speed and on the same page, tell me, what do you make of this shakeup?
Well, I think it still is early to tell exactly how this is going to play out for a couple of reasons. The first is just because one company has come out and said, hey, we were able to do this at this cost, doesn't mean that you're going to see that become the way that most people and most companies can do so. So there are real questions about how this was actually funded within China and whether there were other software technology vendors that were used in order to help produce this. There are real questions as to whether or not other companies can replicate this and start to come up with similar types of developments. And so I think the first thing is seeing how the next few months develop and whether we're able to see more competition that uses these types of things successfully to develop cheaper AI. The second question then is, look, once AI is cheaper to use, do we just start seeing companies using way more of it because it's now cheaper, and that still requires large amounts of capacity? So I think there are a lot of different things that need to get sorted through here. And granted, while the market is showing some nervousness today, it still is unclear to me exactly how this plays out over the next 3 to 6 months, or even over a longer time frame in the next couple of years. So there certainly is the possibility that we continue to see things slide over that time, but we have to be open to the idea that, hey, this is just one step in the evolution of a still very new technology, and we don't know exactly how this is going to play out for the full cycle here.
All right, Chuck, that gives us some good perspective. Now, according to Dow Jones market data, this shift could wipe out more than $1 trillion in market value. What are the long-term effects here? I know you still talk to us about how there are a lot of questions moving forward, but what could some of those long-term effects be?
Well, I think this is certainly something where, it's a great lesson in diversification, certainly, in that investors who have piled into these very popular stocks over the last couple of years, they're certainly feeling some pain today. And there exists the possibility that in the long term, they could continue to feel some more pain. So I think it's a good lesson in diversification in that, hey, just because something has worked in the past doesn't necessarily mean it's going to work in the future in the investment world. You see it on every prospectus out there. Past performance is not indicative of future success. And look, I think this is a good, potentially tough lesson for a lot of investors on that front. But I think that it's going to still be, a little bit of time before we know exactly how this impacts the technology sector and even the U.S. economy as a whole. So there still is so much to sort through here in that we're dealing with a very new technology in AI overall and a very, very new platform that's been released in the last week. And we don't know exactly what the long-term ramifications of that are going to be.
Now, Chuck, is there a chance that tech stocks were overpriced even before this sell-off?
Well, I think it's more than a chance. I think by just about any available metric, you could look at it and say these were very highly priced companies to begin with. But as long as they kept delivering results, it was fine for investors. And look, there still is a chance that they end up continuing to deliver good results. But the big thing with high valuations, they're not predictive of any kind of imminent crash in markets. It's more that, hey, when the pain comes, it tends to be larger then because there is more room for those stocks to fall. So yes, this was absolutely a portion of the market that was very highly priced. It's also one that was growing very quickly in terms of both overall revenue and profit. But I think that those high prices do make it a precarious situation if something unexpected, like this new development out of China, comes to the forefront.
Now, Chuck, are investors now flocking to what feels like safer assets? And if so, which would those be at this point?
Well, you have seen a little bit of movement today in that bonds, which had kind of been poo-pooed by investors for the last, 6 months or so, maybe 4 or 5 months. You've actually seen investors moving in that direction and bond yields moving down. So there is a little bit of that we are seeing today.
Chuck Zodda, we thank you for taking the time to break this down, make it easy to digest for folks. Is there anything that you think is important for people to understand about this moving forward that I didn't ask you?
Well, I think today is a great reminder that there's always something unexpected that happens in technology. Mm-hmm. You got to be on your toes, and you got to be able to adapt quickly simply because you don't know exactly how the situation is going to evolve. And I think this is a great reminder of that.
Chuck Zodda from the Armstrong Advisory Group, we thank you so much for joining us today.
Thank you.